Every money decision is really just this. Do you want the thing now? Or do you want maybe more later? When you spend money now, you know exactly what happens. You give the money and you get the thing. Simple. When you save money, you don't get a thing. You just put it somewhere safe, like a bank account. Later, your money is still there. Maybe a little less after inflation, but it's there. It's predictable. With investing, you don't get a thing right away. Instead, you give your money to something that's supposed to be doing work. A business, a building, an entire economy if you're feeling optimistic. You're basically saying, take this money and build something useful with it. I'll come back later. Later, you check back. And because work happened underneath, one of a few things shows up. If the thing worked well, there's more money than before. If it worked fine, there's about the same amount. If it didn't work, you've just paid tuition to the school of, well, that did not go as planned. That's the key difference. Investing is what happens when you say, I don't need this money right now, and I'm willing to let something unpredictable happen to it. That's already a weird choice, and we've only just started. But the word investing is doing way too much work. People use it like it's one thing. It's not. It's more like saying exercise. Running, lifting weights, yoga, and aggressively pacing while overthinking your life are all technically exercise. But all of them have very different outcomes. Same problem with investing. So let's sort out what people actually mean when they say, I'm investing. Think of investing as sending money forward in time and hoping that when you meet it later, there's a little more of it or a lot more of it. There are a few common ways people do this. Number 1, owning a business or stocks. If you take money and use it to buy a tiny slice of a company and then you just wait, that's investing by ownership. You're saying, I think this business will make more stuff people want. You don't have to know how to build a phone. You just have to own a piece of the company that does. You're hiring the smartest people in the world to work for you while you're at the beach. Here's the catch. Think of a company's monthly income like a waterfall. The water hits the people at the top first. Employees, suppliers, the government. Then it hits the lenders, the banks. You are standing at the very bottom with a bucket. If the waterfall is just a trickle, the people at the top soak it all up and your bucket stays dry. If the company goes broke, the banks get to sell the office furniture to get their money back while you get nothing. Why would anyone agree to be last in line? Because unlike the bank or the employees, there's no limit to your earnings. An employee gets their steady salary. A bank gets its 5% interest. No matter how successful the company becomes, their pay stays roughly the same. But because you take the risk of getting nothing, you own the right to the growth too. If the company invents a product that changes the world and its profits grow by 1,000%, your slice of the pie grows by 1,000% right along with it. You aren't just hiring smart people. You're the person who wins big if they succeed and loses first if they fail. Owning a thing that produces value. Real estate. Here, you buy a physical thing, maybe a house, an apartment, a building that will absolutely have plumbing issues. Real estate isn't just houses. It's owning a piece of the earth that someone else needs to use. Whether they live there, store stuff there, or sell tacos there, they pay you rent, which is basically a subscription fee for existing on your dirt. You're hoping for two things in real estate. First, it pays you while you own it. After you pay the bank for the mortgage, the city for taxes, and the plumber to fish a Lego out of the toilet, whatever is left in the bank account is yours to keep. Second, it's worth more when you sell it. You're hoping the dirt itself becomes more valuable over time because a Starbucks opened down the street. Unlike stocks, which you can sell instantly, a house is a frozen asset. If you suddenly need cash for an emergency, you can't just sell the front door. It can take months to find a buyer and actually get your money. Most people use a massive bank loan, a mortgage, to buy a home. If you pay $20,000 upfront to buy a $200,000 house, you still owe the bank $180,000. If the local market crashes and your house's value drops to $150,000, you're in trouble. You now owe the bank $180,000 for a house that is only worth $150,000. You are underwater, meaning you'd actually have to pay the bank an extra $30,000 just to get out of the deal and hand them the keys. However, if the neighborhood thrives and the house value climbs to $300,000, that original $20,000 investment could effectively turn into over $100,000 in pure profit, allowing you to essentially use the bank's money to get more money. Number 3, buying a little bit of everything, or more commonly called funds. Buying one stock is like eating a single strawberry. If that one strawberry is rotten, your whole snack is ruined. Buying a fund is like putting 500 different fruits into a blender and making a smoothie. Even if 10 of those strawberries are total garbage, the other 490 fruits are so sweet that the smoothie still tastes great. You'll never have the perfect taste of a single amazing strawberry, but you'll also never get sick from one bad one. A fund is a simple product that uses your money to buy small pieces of many companies at once. You're basically saying, I don't know who will win, I just want to be there when it happens. But because you own all 500 companies in the fund, you also own the losers. When a new company explodes 1,000%, your fund only goes up a little bit because that winner is diluted by 499 other average companies. You are trading maximum wealth for maximum probability of not being broke. And it works because over time some companies fail, some do fine, and a few do most of the growing. You don't need to know which ones in advance. It's a surprisingly effective strategy, which annoys a lot of people who spent a lot of time trying to be clever. Number 4. Lending money, investing in bonds. This one is the grandpa of investing. If owning a stock is like being the boss, then buying a bond is like being the bank. You aren't buying a piece of the company, you're just giving them a high-interest payday loan and hovering over their shoulder until they pay you back. When you buy a bond from a government or a big company like Netflix, you're saying, here is $1,000. Go build your bridge or make your movie. In exchange, I want my $1,000 back in 5 years, plus a little subscription fee every month. Remember that waterfall of money we talked about? Bondholders are at the top. Before the CEO gets a bonus or the stockholders get a penny, you are the one who gets paid first. You don't care if the company triples in value or stays exactly the same. As long as they don't go bankrupt, you get your money. The reason this is the low excitement version of investing is the ceiling. If you lend a company $1,000 at 5% interest, and they suddenly invent a teleportation device and become the richest company in the history of the galaxy, you still only get your 5% on the original $1,000. You don't own the success like you do when you own a stock, you only own the receipt for the loan. If you're earning 4% interest, but the price of eggs and gas goes up by 5%, you are technically getting richer on paper while getting poorer in real life. Number 5. Speculating, trading, crypto, etc. This one pretends to be investing, but it's really not. Speculating is the loud, caffeinated cousin of investing. You aren't buying a company because it makes great phones or buying a house to rent it out. You're buying a digital potato solely because you think someone else will pay you twice as much for that potato tomorrow. In the industry, this is called the greater fool theory. You might know you're paying a ridiculous price for a Bored Ape drawing or a coin named after a dog, but you don't care. As long as there is a greater fool standing behind you willing to pay even more. To a layman, derivatives sounds like a math headache and day trading sounds like a job. In reality, they are just ways to turn the volume up on the gamble. Day trading is investing with the attention span of a goldfish. You aren't waiting for a company to grow. You're trying to guess if the vibes of the market will shift in the next 3 hours. Derivatives, also called options or futures, are basically side bets. You aren't even buying the cow, you're buying a piece of paper that says, I bet $100 the cow will be 10% more expensive by Friday. If you're right, you win big. If the cow stays the same price, your piece of paper becomes worthless trash instantly. Speculating is the only type of investing where you can wake up a millionaire and go to bed wondering if you can afford a McDouble. Sometimes, the thing everyone laughed at, like Bitcoin in 2011, actually turns into a giant pile of gold. The people who bought in early stop trying to explain the math and just start posting pictures of their new Lamborghinis. Because there's no useful work happening underneath, no lemonade being sold, no rent being collected, the investment is based entirely on hype. If the hype dies, your money dies with it. So those are the main ways people invest. And almost every new investment idea is really just a variation or combination of these instruments. Out of all these options, stocks are where you can actually see investing happen, because prices move constantly, and people keep buying and selling, which means the stock market is where it all plays out. The stock market is basically an auction for future cash. Imagine a room full of investors. On stage is a machine that prints $100 every year, forever. Everyone wants to own it, so they start shouting prices. $500, $1,000. Why would someone pay $1,000 for a machine that only prints $100 a year? Because they believe it will keep printing money for a long time. Suddenly, someone hears a rumor. Next year, the machine might print $200 instead. Suddenly, everyone wants the machine and the bidding war explodes. That room is the stock market. The machine is a company. And the shouting is investors arguing about how much that future money is worth today. In the stock market, the price of something isn't determined by what it's worth. It's determined by what someone is willing to pay right now. Eventually, the shouting stops. One investor, let's call him Dave, wins the auction. Dave pays $1,500 for the machine. Because Dave thinks, if it prints $100 every year, this thing pays for itself in about 15 years. Everything after that is profit. So Dave takes the machine home. Every year, the machine spits out $100. Dave didn't sell anything. He simply owns the machine, so he gets paid. That payment is called a dividend. Some investors buy stocks specifically for that steady cash flow. 5 years later, Dave has two possible outcomes. Scenario 1. The upgrade. People discover that the machine actually prints $150 a year. Demand skyrockets. Dave brings it back to the auction room. Someone shouts, "I'll give you $2,500 for it." Dave sells him the machine. He collected $500 in cash over the years and made $1,000 profit on the sale. Dave looks like a genius. Scenario 2. The breakdown. Imagine a new company invents a digital money printer. Dave's machine suddenly looks obsolete. Or maybe it starts malfunctioning and only prints $20 a year. Dave rushes back to the auction room. The crowd is not impressed. One guy finally offers, "I'll give you $300 for it." Dave sells him the machine to cut his losses. He earned some money along the way, but he just lost most of what he paid to buy the machine in the first place. Dave's story might sound like a simple example, but it's basically what happens in the stock market every single day. When the news says, stocks are crashing, nothing physical actually crashed. The machines are still there. What changed is the crowd's expectations about the future. If investors believe the machines will stop printing money, prices fall. If they believe the machines will continue printing, prices soar. So the stock market is really two things happening at once. Businesses producing real cash, and investors constantly arguing about what that cash is worth. Now you know how the stock market works, but the people in the room speak a different language. Let's do a 90-second speed run so you don't get confused. Bull versus bear. It's just the market's mood. A bull market means investors think prices will go up. A bear market means prices are expected to fall. Think of it like this. Bulls charge up, bears hibernate and drag prices down into a hole. Market cap. It's the total value of a company in the market. It's the number of shares multiplied by the current share price, basically the company's price tag. P/E ratio. This is the price of admission. It's how many dollars you have to pay up front just to own $1 of the company's yearly profit. Blue chips. These are the grandpa companies. Huge, stable, and boring like Coca-Cola or Walmart. They aren't going to double overnight, but they aren't likely to vanish tomorrow either. Initial public offering, IPO. It's the first time a private company lets the general public buy a piece of the pie. Fiduciary, the legal guard dog. Most advisors are just salesmen in suits, but a fiduciary is legally required to put your interest before their own paycheck. If they aren't a fiduciary, they're just a broker looking for a commission. Liquid versus illiquid. How easily can you use it as money? Cash is liquid, you can spend it immediately. A house, on the other hand, is illiquid, you can't use it to buy groceries at the store. Dividends. The thank you check. Some companies share their extra profit by mailing you cash just for holding the stock. HODL, holding on for dear life. It's the strategy of refusing to sell, even when the news is screaming that the world is ending. Dollar cost averaging, DCA, the automatic pilot. You ignore the news and buy the same amount every month, rain or shine. You buy more when it's cheap and less when it's expensive. Arbitrage, the middleman's jackpot. Buying low in one place and selling high in another instantly. It's usually done by computers in milliseconds. Now you speak the language. But none of those words matter if you're bleeding cash to people who didn't do any of the work. The market doesn't just give, it takes. In investing, it's not just about how much you make. It's about how much you get to keep. Along the way, there are small cuts that take a piece of your returns. The first is fees. If you're investing through something like a fund, your smoothie of many stocks, there's usually a small percentage taken every year. That money goes to the company or people managing the fund, basically the ones choosing the ingredients in your smoothie. This fee is called the expense ratio. It might look tiny, but it's taken every year on your entire investment. And over time, that small percentage quietly takes a much bigger cut than you expect. Then there are taxes. When Dave sells his machine for a profit, part of that gain goes to the government. This is called capital gains tax. To reduce this, people use specific types of accounts called tax-advantaged accounts. The idea is simple. Inside these accounts, your investments are allowed to grow without being taxed along the way. In some cases, these accounts delay taxes until later. In others, you avoid certain taxes altogether. Either way, less money is being taken out while your investment is growing. And over long periods of time, that difference compounds. Because making money on your investments is one thing, but getting to keep that money is what really makes the difference. Risk, the price of admission. Most people treat risk like something they can avoid, like if they're careful enough, they won't have to deal with it at all. But the reality is, there isn't any 100% safe option in investing. Every choice comes with some kind of risk. Even doing nothing has a cost. Even if you bury your cash in a hole, inflation slowly reduces what that money can actually buy over time. In investing, risk is what makes returns possible. A stock or a piece of real estate can give you a profit only because there's a chance it could lose value too. If it was guaranteed, there'd be no extra return to earn. So you're not getting paid for luck, you're getting paid for taking on that uncertainty. So, what's the point of doing anything at all if everything has a risk? To keep your sanity, you have to distinguish between the world is ending and one guy is an idiot risks. The world is ending risk. A global war, a total economic collapse, or a zombie outbreak. There is no strategy for this. If the entire world stops working, your portfolio is just useless numbers on a screen. At that point, the best investment is probably canned beans and a sturdy fence. Most successful investors simply bet that the world won't end, mostly because if it does, the losers and winners both end up in the same ditch anyway. The one guy is an idiot risk. This type of risk is optional. This risk is highest if you invest all your money into one company or stock. If an idiot CEO makes a bad decision and runs the company to the ground, your investment goes underground too. You know, those stories you hear in the news. Now, here's the issue. If you've invested all your money into that one company's stocks, you go down with it. Your money is basically riding on decisions you don't control. Some executive you've never met makes a decision, and your investment follows it. Good or bad. You can't predict which CEO or which company is going to make a bad call and ruin your investment. So how do you keep one company from having that much control over your money? That's where diversification comes in. Instead of putting all your money into one stock, you spread it across multiple investments. You invest in different companies doing different things. Some of these are tech companies, others are banks. Some sell oil while others make consumer products. These are companies in different sectors. They operate in different parts of the economy. So if one part slows down, the others don't necessarily follow. This strategy is called sector diversification. You can also spread your investments across different countries, so your money does not depend on just one economy doing well. It's called geographic diversification. And beyond companies, you can invest in different types of assets. Stocks are one. Bonds are another. Real estate could be another asset. When the value of one goes down, another might stay steady or even go up. This approach is called asset class diversification. In investing jargon, the names are different, but the idea remains the same. Don't let one bet control everything. Of course, if you spread your money too wide, your wins get smaller. But for most people, the lower risk makes it a fair trade. The key here is that you're not depending on one company to get everything right. And that sets up the most important part of investing, what happens over time. This is where time starts doing the heavy lifting. When you invest, time is what drives your money to grow. Imagine you invest $1,000 and it becomes $1,100. That extra $100 does not sit separately, it stays in the investment. Now, the next time it grows, it's not growing from $1,000 anymore. It's growing from $1,100. So, the growth is now based on an even bigger number. And if you keep leaving the gains inside, this growth keeps repeating. At first, the difference feels small, but as the base keeps increasing and time keeps passing, the growth starts coming more from past gains than from what you originally put in. That process, where the profits stay in and start generating their own profits, is called compounding. Along the way, prices keep moving, so the value of your investment keeps going up and down. That's called volatility. It's normal, and it's part of how investing works. Some people try to avoid these ups and downs by buying and selling at what they think are the right moments. That's called market timing. It sounds logical, but in practice, it often leads to worse results. Instead, staying invested for long periods, called long-term investing, or simply holding, is what allows compounding to work properly. If you remain invested long enough, compounding almost always works in your favor. So, when we look at all of investing, it looks like a chaotic mess at first. But once you see the mechanics, you realize that most of the financial industry is just people trying to charge you a fee to explain something you now understand for free. At its core, the system only has two roles. You can be a consumer, someone who spends their life paying for the present, or you can be an owner, someone who gets paid for the future. The machine doesn't care if you participate. The inflation termites will keep eating, and the auction house will keep shouting whether you're there or not. You can either be the person paying for the world or the person who owns a piece of it. The choice is yours. Good luck.